The Bank of Japan gave the yen a warning about inflation. The yen apparently wanted an interest rate. On July the 31st, the BOJ kept its overnight rate around 1.0% by an 8-to-1 vote, while board member Hajime Takata wanted 1.25%. In Reuters' post-decision snapshot, Japanese two-year yields rose, but the yen failed to hold strength and traded near 160.67 per dollar. That contradiction is the story. A central bank can sound more hawkish and still deliver no additional tightening today. The statement changed expectations about future policy, but the policy rate underpinning yen funding conditions remained unchanged. Currency markets heard a tougher adjective, then checked the number. The BOJ had real reasons to sharpen its language. Its July outlook said underlying inflation could move above the 2% target as inflation expectations rise and firms become more willing to increase wages and prices. The bank also flagged upside pressure from global AI-related demand, semiconductor prices, and the yen's depreciation. This was not empty theater. It was a stronger warning about the inflation path. But foreign exchange markets price relative returns, not one central bank in isolation. If US yields and dollar demand remain high, while Japan tightens only gradually, yen-denominated cash can still offer less carry than dollar-denominated cash. That means higher Japanese short-term yields can coexist with a weak currency, while the broader rate gap remains large. The yen was not ignoring the BOJ, it was comparing the BOJ with everything else. Positioning can make that reaction even messier. Reuters reported speculative net short yen positions worth about $11.65 billion, close to a two-year high. A crowded short can create sharp covering rallies, but it does not guarantee a durable reversal. The market can panic for an hour and remain unconvinced for a week. This is why hawkish is not the same as tight. Hawkish language can move expectations, but durable yen strength would need confirmation from actual rate hikes, a narrower US-Japan yield gap, lower US yields, or a sustained unwind of short yen positioning. Without that confirmation, words may slow the move without changing the mechanism. The market heard the warning and kept the carry trade open. The next test is the US Employment Cost Index at 8:30 a.m. Eastern. A softer result could pull US yields and the dollar lower, giving the yen room to recover. A hotter result could reinforce the opposite pressure. That is a scenario, not a prediction, and one data release does not decide the BOJ's entire path. What matters is whether the reaction changes the relative rate story. So the BOJ did not necessarily lose credibility, and the yen is not guaranteed to keep falling. The decision simply exposed the difference between signaling future concern and changing current financial conditions. Watch the rate gap, the dollar, Japanese short yields, and whether yen gains can hold after the headlines fade. Currency's price policy, not adjectives.